Foremost means more. More training, more information, more ways to grow your business. Find out what Foremost can mean for you at foremostagent.com. Click on Foremost Means More.
Earlier this year, just after Aon Benfield published its Reinsurance Market Outlook report, the chairman of Aon Benfield Analytics, Bryon Ehrhart, discussed the reinsurance industry's record level of capital, $500 billion by Aon's tally, and how a supply-demand imbalance is reshaping the industry with carrier management Susanne Sclafane.
It is a record level of capital, so that's why we highlighted it, and it's a growth in capital of about 10% just through 3 quarters last year. So the fourth quarter, even though impacted by Hurricane or Superstorm Sandy, it won't have a capital impact on the industry. The capital will still grow in that quarter. So 2012 will end as a very large amount of capital in the industry. That capital growth occurred while the change in purchasing habits of reinsurance, which we monitor, really were about flat for the capital-consuming catastrophe component. And then for the non-catastrophe lines of business, there's actually a reasonable drop-off of reinsurance demand from insurance companies raising retentions on a per-risk basis. And the drivers behind that are really comfort with the underlying non-catastrophe results. There's been, for many reasons, a decade of declining frequency that have made carriers more comfortable with retaining that risk. And the severity growth has been quite reasonable, so quite manageable. It's not something that's presenting the kind of volatility that people think they need to reinsure. That may change, but over the last decade, the volatility has dropped, and the value of reinsurance hasn't dropped. It's just that the volatility of the underlying business has been fine.
Supply-demand dynamics are forcing reinsurers to adjust their business models, according to Aon Benfield's outlook. Ehrhart explains the firm's prediction that half of the reinsurance industry will be involved in fund management within the next 5 years.
Yes, as we highlighted in our report, it's not a surprise change. It's one that we've been witnessing, but it was actually accelerated by the 2008 crisis that brought global governments to lower their interest rates to stimulate economic activity. And that lack of yield has driven many new people into an interest in the space. So while it's been a problem for reinsurers and insurers not making the kinds of investment income they have historically, pension funds, life insurers, high net worth individuals, and endowments are also not making the kind of investment income that they used to. And they've taken a look at our space and said the returns from this space are not correlated to general economy. They are correlated to Mother Nature and other kinds of acts, in the case of terrorism and other things like this, but they just generally don't feel like they're correlated with interest movements and equity market movements. So we have much greater interest now in our sector from those yield-seeking investors. And that is changing the dynamics of even the most volatile product, the catastrophe product. You have so many new entrants in looking at that business differently than 100% equity-financed reinsurance companies, or largely equity-financed reinsurance companies. So reinsurers are, as we highlighted in the report, more often now over the next 5 years going to be joining that phase, because there's nothing in the 5-year outlook that says the economy is probably going to be so strong those people won't continue to have the kind of interest they have. So we'll see the top reinsurers getting into the fund management business, where they're managing those funds that are available to help our clients manage catastrophe risk more and more cheaply to provide their insurance products. Many have a good start already, so some of them have track records pretty well established in this space, but that's probably a grouping of about 5 of the top 40 reinsurers, and we were just saying, but in 5 years' time, 20 out of the top 40 will be actively engaged in this business. And, to better serve their clients with cheaper forms of underwriting capital, and to, be part of this new flow of capital into the business. And it's going to be difficult to be a reinsurer 100% equity financed, competing against people that are looking for debt-like yields in this space. So there will be that transition.
Ehrhart went on to explain exactly how reinsurers are getting involved in new areas.
Yeah, it's really 3 aspects. So the first one is the managed funds. So you brought that up first. That's obviously an area, but that's where pension funds, life insurers, endowments, high net worth individuals are willing to give an investment manager a mandate to buy CUSIP and rated bonds. So they can understand a bond that they can buy into insurance risk and then trade out if they need to over time. Most of the investment banks We run a secondary trading desk that allow people to buy bonds at issue and in the secondary and then resell them. So it's a product that's getting reasonable level of liquidity. So the managed funds mandates will be given like they are for some of the larger funds that are out there. You have between $3 and $7 billion funds already assembled that do that business today. Those aren't run by reinsurers today. They will have a greater influence with reinsurers entering that funds management business. Many reinsurers took the view that maybe these monies are temporary. That view kind of held for a bit, but given the 2008 financial crisis and the aftermath where people are seeking yield, I think reinsurers are coming to the realization this money is likely to be here and continue to grow. Second aspect, of course, is the catastrophe bond. So if reinsurers have retrocessional needs or want to transfer part of their tail, say for U.S. hurricane, one of the cheapest form of retrocessional capacity is the cat bond. Largely the reinsurers have ignored that as a source of capital. So most of the cat bond business is actually done by direct insurers who then enter the cat bond market without a reinsurer involved in that process. Still, the reinsurers can benefit and offer more traditional insurance product by doing a cat bond that has maybe a 600 to 1,000 basis points annual expected cost, but that's still far cheaper than their equity capital that's supporting their tail. So it's going to be accretive underwriting capital to take on or to sponsor a cat bond that'll get them the capacity to write more traditional business. And then lastly, in this phase, and I say lastly because it's probably just the underlying economics of the business don't support the sponsorship of lots of sidecars right now that are doing total portfolio positions. Are going to be much more selected kinds of transactions in retro or very specific accounts or very, very specific activities. So those three food groups, if you will, of new capital coming to the industry and how reinsurers will interact with it, it'll be managed funds, cat bonds, and sidecars, probably in that order for a while.
The supply-demand dynamics will also mean consolidation and share repurchases, according to Aon Benfield's 2013 Reinsurance Industry Outlook. Here, Ehrhart explains.
Yeah, when you see that there's this lower cost capital coming in to support tail risk for insurers and even reinsurers, then the capital that's there in equity form to support those tails, if there's a substitute that's cheaper that's available and it can be locked in over 3 and 4 and 5 year terms, as some of these sidecars and cat bonds and other kinds of things can be most commonly 3-year terms, you start to say, well, what do you do with capital that was there to support it before if I can support it? Well, it works its way into, first, probably buybacks. Many reinsurers are trading below book value today, and it's pretty accretive math to say, I buy back shares below book value, my book value per share on a post-buyback basis looks a lot better. So that's pretty accretive math to do. And then as you look in the future and say, well, am I ever going to need that capital back? Well, maybe if the market that supplies new capital breaks down, so maybe I need just contingent capital, or maybe I need the way to structure some of the efficiencies into a smaller business model for the traditional business, and maybe that drives consolidation. So if I don't need the capital and I'm buying back shares, if I combine two organizations, could I buy back more shares and take some of the expense out of the equation? That's probably going to start happening. It's been a slower pace on consolidation in the reinsurance business than I think many had foreseen. But these new fundamentals, these new drivers are real. So, yeah, I think the fundamental area that we're pointing to in the report that is likely going to see some consolidation is going to be around property catastrophe, where there isn't an increase in demand for the product. Even after significant events in 2011, after most big events like that, you saw reinsurance buyers go out and buy materially more cover. And that really just didn't happen. Even though those events were tragic in Japan and Thailand and Christchurch, most of those clients thankfully didn't go through their reinsurance programs. They didn't come out the top of the programs or fully exhausted programs. So you didn't see that increase in demand. And if demand in the U.S., which is the main driver for U.S. hurricane, if that's not growing very quickly, then you have businesses that are producing more capital through profits, and they're just going to find a way. If it's not growing, you're going to grow through consolidation.